Oh my gosh, did it work?
It worked correctly, I think, even too. I was just going to ask you what you did to fix that, and then it
The
just
ongoing saga of, will this work this week? Yeah, that's
will.
great.
Well, it works. It's just a matter of how it displays, right? So
Right.
how will it display? So happy Friday Fun Day again, Mr. Kaufman. How are we doing today?
I am doing all right. I've tweaked my back, so I'm going to get my complaining out of the way right up front. I have done
Great.
something to my back that it's been rather debilitating. Crazy. It's just age. It's just this osteoporosis setting in, or whatever you call that. I think that's what you call it.
Yeah, I was saying between working on rehab projects and your CrossFit regimen, you probably tweaked something there.
It's weird because I have literally, over the winter I did a couple projects. I did a project for my wife on one of her rental properties, and I did my own house, remodeled my own house. And I've literally been bending over all winter long. Like I've been on my hands and knees, just swinging hammers and stuff since what, November, December.
Yeah, but
No problems,
solid
no problems at all. Then just
month.
all of
Oh
a
yeah.
sudden. So anyway, there's my complaining for the day. What about you? What do you got to complain about?
Perhaps you're just too much of a delicate wallflower. Just
It
putting
could be. It could be. Or I'm turning into.
that
Yeah.
is farthest from the truth. You're tough as nails that I've witnessed. So yeah.
It does kind of remind me, like, I don't know. I just the prospect of me sitting at a desk all day, it scares me to death. Like I just am not. I'm not built to do that. Anytime I've ever had to do that for an extended period of time, I've felt like I've literally felt like I've been beaten up by the end of the day. It's just it's brutal. So I'm just not built for it, man. I'm not built for sitting, and but I think I might have to start embracing that a little bit here. In fact, my body's forcing me to embrace it right now. I
Yeah.
have to. I can't. I just can't move.
Yeah.
But
Well,
anyway,
welcome to another episode of the Creative Real Estate Mastery Podcast. It's powered by us here, the gentlemen at Sub Two Empire. So we are glad that we're here for another installment. And what do we have on tap for the topic today, Mr. Kaufman?
well, I thought we would talk. Actually, I think you came up with this one. You did come up with this one. See, my brain's not working. Um, but yeah, this is a good one. We're going to talk about um, how to structure creative deals, or how to structure payments rather. How do we reverse engineer and get back to the payments that we are going to present to our seller finance buyers? That's what we're going to talk about. So it is a reverse engineering type of thing that we have to do. A lot of factors involved in it. One of those being, um, I think for me at least, the primary one being, what is my competition charging for interest rates? That's one of the big ones for me. And can I match that, or can I get close to that while still offering incredible value? So um, so yeah, let's just dive into it. Let's just get into it if you're ready.
I'm I'm ready.
Okay.
So one of the things here too. So let's just take it from the beginning, shall we? So at Sub2 Empire, we love the seller finance model. In other words, we buy a property subject to specifically, let's just say, so we buy a subject to property, and then
Preferably.
we want to turn around and put an end buyer in that, and then we're going to seller finance to them. Maybe it's on an agreement for deed, maybe it's a wrap mortgage, depending on what you want to do, right? So those are the two ways we could seller finance it to somebody. So what we're going to do is talk about how we arrive at those terms and conditions when we make that seller or to find that buyer for our seller financing terms, right?
That's right.
So we're going to, why do we love that model so much, Mr. Kaufman? Maybe we should start with there, right? Like why do you love being able to seller finance properties to end buyers?
I know if anybody's watched this podcast before, or listened to us before, they know exactly what I'm going to say. But for me, um, I don't have any outside sources of income. I have a couple, a couple little things that produce cash flow for me. But for me, I have to have cash flow. I quit my job, almost 7 years ago, 7 8 years ago now, and so I have to have cash flow. Like there's no question. The problem is I'm the worst landlord on the planet. You're not going to meet a worse landlord. I'm just awful at it. I hate it. It just doesn't. It doesn't. I like sleep as well. So therefore, if I'm a landlord, I just many countless nights of not being able to sleep. So for me, that's what it is for me. It's not just. It's probably even less about the cash flow, honestly, than it is the just just my distaste and dislike for being a landlord. The seller finance model is perfect for someone like me. I just don't like dealing with people.
Well, you just shifted. Like, I mean, there's a reason because you dislike something, but you actually shifted your mindset, right, from being a landlord to a note lord,
Yeah.
right? So now you're a
And
note lord.
unintentionally, by the way, unintentionally, because believe me, my my intention was to get out of being a landlord. I would prefer to have a job than be an actual landlord. That's just how much I hate it. I hate being a landlord. But yes, you're correct. Kind of inadvertently, I became a note lord.
Yep.
Yeah.
And, and one of the big reasons, right? So correct me if I'm wrong, but one of the big reasons you found it said to Empire was to teach other people, right, how to do that and then how to profit on that, right? So the seller financing model is brilliant because you get paid three times.
Yep.
You get paid, right? So you find that buyer, you're going to get a down payment from your buyer, right? Which we're going to show you an example here, which hopefully makes you whole from whatever your costs are to acquire the property.
Hmm.
And then you're going to get monthly cash flow, which is your number one rule. Like, what's my monthly cash flow? Like, that's your number one standard. And then you get a spread from the sales price at the end. So ultimately, you're going to get paid off. Maybe it's 30 years from now, but typically it won't be. Like, it'll probably be 5 to 7 years, and they'll refinance or whatever and pay you off. And now you're going to get that lump sum spread at the back end,
Yep.
right? Not to mention some potential tax depreciation that you might have along the way as well. But depending on how you structure it, but those are the three big things. So it's a beautiful model, right?
Yep.
What other model do you have where you get paid three times on a deal?
Yeah. It's not through a. I mean, you technically could get paid. If you were a landlord, uh, you could technically get paid the same way through lease options. Although, generally speaking, an option when somebody purchases an option contract from you, it's generally for a much lower amount than the down payments that we receive when we sell or finance a property out to a buyer. But you could potentially do that just in a probably a much more what's the word I'm looking for? Many more headaches, if you ask me. If you go through that model, if you want to do a lease option, then you become a landlord because that's ultimately what you are when you lease option a property to a tenant buyer. So you have those headaches, and then maybe down the road, if your tenant buyer does not perform, or maybe they do perform, you can get paid, on the back end of that. Otherwise, it's kind of just a rinse and repeat of. Again, I'm going to bash it a little bit, but kind of rinse and repeat of constant headaches, and I'm just not down for that. I don't like it.
Now, I will say this though. I mean, you're right. So being a note lord is much less stressful, right? Much less problematic than being a landlord. But it also has a whole lot less tax benefit. You,
That's
you still
true.
have some, but you can't take off all the. I mean, you don't get all the tax benefits when you're an actual landlord. Active versus passive. So you kind of need to decide. This goes back to your buy box. People, we keep telling you this all the time. Like, we should, like, what's your buy box? What are your business goals and what are your personal goals and what are you looking for?
Yep.
Right? If you're like Mr. Kaufman here and you want cash flow, perfect model for it. But cash flow without the toilet, trash, and tenants, right? The three T's, the terrible T's, right? That's what you're looking for. So that's what we're going to talk a little bit about today, hopefully. So let's get back to the model. So what are some key items, key components of finding out what that payment? So we're the bank now, right? You're going to be the seller finance, so you're going to be the bank. So when you're the bank and you want to structure those terms of the delays and you want to get an end result from a monthly payment, what are some key components you look at, Mr. Kaufman?
Yeah, you cut out there a little bit for me at the very end. I think it's probably me, but but I think I know where you're going with this. Um, I think I will definitely get to answer that question, but I want the people to understand that payment structure, to me, at least from my point of view, matters just as much, if not more than price matters. Um,
Yeah.
so being and really, if you well, you can go out and download our calculator, and you can actually see what I'm talking about. We can put that into real hard evidence for you.
Yeah.
Um,
Which we'll go over in just a minute by an actual example. Yeah.
yeah, but um, payments to me over the long term. I mean, if you structure that correctly, you can make you can make an absolute killing on terms. And so terms to me mean they're just as important uh, or even more important than the actual sales price. That being said, the key components in a seller finance deal are going to be number one, your purchase price, or the buyer's purchase price rather, not yours.
Yeah. Yeah. Your selling price. Yeah.
Right, right. Your down payment, the um, the term of the loan, or how the loan is amortized, and also the length of the loan. They're two different things.
Yes. Yep.
And then you have your interest rate. And when I was talking to at the very top of this podcast, competing, I don't know if competing is the right word I'm looking for, but definitely being very aware of what the interest rates are doing in the market currently, and trying to be, at least for me, trying to make it so that I can somewhat compete with what the bank's interest rates are. A lot of times it doesn't work out. It's just not the way that it is. But I'll tell you, these interest rates right now, where we're at, I'm finding it pretty easy to be able to compete with the banks right now. So,
Can I just say something about the interest rate, which
yeah,
we can talk about more of it when we pull up the actual calculator example. That I think sometimes people worry too much about, okay, I need it to be at 9% or I need it to be at 8.5%.
yeah,
No, you need it to be at what your monthly cash flow was. Like
correct.
what is your number? You want $500 a month from that? What then using our calculator, right? Then you can just say, okay, what does that make the interest rate? Right? You can easily see. So maybe it's 7% or maybe it's 8% or whatever it is, right? But don't get so hung up on, well, I have to be 2 points above the bank rate or whatever. No, you have to set the terms that you're comfortable with, that meet your buying parameters, that meet your business goals, that get you the monthly cash flow that you want, right?
That is,
Don't overthink it.
yeah. I mean, unless you're in like strictly in the note business, where you want to create a marketable note, and you want to later then sell that note.
Yes,
Uh,
more institutional style. Yes.
yeah, if that's your thing, then at that point you need to start thinking about, well, my notes need to be, the interest rate in my notes needs to be a minimum of 10%. You kind of have to meet that to make that attractive to a buyer somewhere. It's not what I'm interested in. I like the cash flow. I need the cash flow. So I am going to I'm going to do exactly what you're saying. Is I'm going to figure out what my spread needs to be, or I mean, everyone should have a minimum monthly spread, no matter what, whether you're into rentals or like seller finance like we are. You need to have an established minimum monthly spread. I fudge on mine sometimes. Sometimes I go a little bit lower uh, than what I would consider my normal. But I always seem to make up for that in purchase price or down payment. So, um, but yeah, interest rates, and all we're doing here, again, if you've not listened to us in the past, all we're doing is arbitraging interest rates. That's
Yep.
all we're
Yep.
doing. We're looking at if we take something subject to, we're looking at what that interest rate is, and then we're creating a spread by charging a higher interest rate. That's all
Yep.
arbitrage is. That's all we're doing.
And that in turn makes your monthly cash flow.
Correct.
That is the monthly cash flow, the difference in the interest rates. So.
Yep. Yep.
So it's but one thing you mentioned, I just want to just in case, because we'll get talking about the example and we won't come back to this too. But I think what you said there is important. So talk about the loan terms. So the term of amortization and the length of the loan are not necessarily the same things. So for instance, right, you can just set your loan up to be 30-year amortizing. It's a 30-year loan, like they'll refinance or whatever, that's fine. But you can also have a 30-year amortizing loan but balloons in 7 years. And I'm just going to use balloon as the easy term everyone understands. I realize you can't quote unquote have a balloon loan in many states and jurisdictions, but you can have all the principal balance due and payable at a certain time and just not use the word balloon, and that's okay.
Yeah, it's
Ignorant, stupid, but whatever. So I'm just gonna say balloons. Like you can have a 7-year balloon payment, but it's still amortized over 30 years. Maybe it's amortized over 20 years. Maybe it's amortized over 15 years. Like you can control and set all that, and you're tailoring that to your end buyer, right? These are the things that you can work out with the benefits. I mean, you need to have some things that are set in stone. Like it's not going to be less than this. It's not going to be more than this too. But then you can tailor it. I think what you said is important. This is a particular property that a particular person is buying, and you can tailor things a little bit to meet their needs.
That's right. Yeah, you can. There's a balance. We're going to get into this here. In fact, I think it's coming up here. But there's a balance between the payment that you are requesting from your buyer and the cash flow that you know you need to make. And I think you know you definitely don't want to you want to set your buyer up for success. That's what you want, because you want reliable cash flow here. And
Yep.
so a lot of times what I see is these folks go out there like they're like sharks, and they go out and they set these terms up, and they feel good about the fact that they're getting you know X amount of dollars above what market, like what market rents would be, for example. But they're getting that in the form of a payment on a loan uh, that they've given to their buyer. But for the long term, I mean, if you don't set them up for success on something that they can afford today, I mean, I just think it's going to be uh, you're going to have a lot of problems. You're going to have some issues. I mean, because now let's I'm gonna dive into this just a little bit, because now let's say that you've conveyed legal title, you've got a note, but that note, the terms in that note, your buyer can't really afford. Now you get a non-performing note. Well,
There's your dog sitting going.
yeah, yeah. But so now you've got a non-performing note that you have to foreclose on potentially, or now you've got a non-performing note that you're going to try and sell on the open market. You think somebody's going to give you the cash that you need for a non-performing note? It's going to be discounted, insanely discounted. So I might be talking a little more detailed than what we need to be talking about, but my whole point is finding this balance between your minimum cash flow requirements, or your cash flow requirements, I wouldn't even say minimum, and affordability for your buyer. And that's why I love terms so much. I love being able to get in there and structure those things, and work with the buyer on this. Find out what they can't afford. Find out what they're. We do pull credit history. We pull. We ask them about their finances and all that good stuff.
You have to vet them for sure.
Yeah,
Absolutely.
yeah. So why don't we talk about how we actually
Yeah.
about how we actually come up with a monthly payment?
Sure. Okay. So first things first. You have a property. I think it was 123 Walnut Street that we'll bring up here when we walk through an actual example with the calculator. 123 Walnut Street. You have this actual property. Okay. So the very first thing to do is, what does this property rent for? What is market rent for this property? So you have to figure out what that is, right? So you need to pull You can maybe pull leasing comps from the MLS if you're a real estate agent or have a real estate agent friend. You can go on Zillow and do something, and Zillow is becoming much more accurate depending on where you are too for rent estimates. You can go to Rent-O-Meter. You can go to all different sources to get, okay, what is market rent? And typically you're going to get a range. So let's say we have market rent here that's 1,800 to 2,200, just as an example. So you want to structure your payment, right? You want to put your payment in that range. And Jeff and I differ a little bit on this. If it's me, I'm at the top end of the range. I'm not on the low end. I'm on the top end of the range. I'm seller financing this to somebody, right? I'm not a landlord. I'm seller financing this. And so because of that, this is non-traditional funding, right? So because of that, I should get a bit more, right? Or be at the top end of that rent. Okay. That's my philosophy. That's my general rule of thumb.
Yeah, I'm not far from that. I do like to be 90 to 95% of local rents. That's where I like to be. And my line of thinking on that is, you know, I don't know about you. When I bought my very first house, I was shocked to see that my payment was actually going to be lower than what I could rent the same house for in that neighborhood. I was shocked, and I was like, "Oh my cow!" So that's kind of stuck with me over the years, and even before I got into this business, it's stuck with me. It would be cheaper to buy a house. Now, we all know that that's not true because houses require maintenance. But as far as your monthly payment goes, is monthly outflow of cash, it's a little bit cheaper to actually pay into equity building in a house than it is to for rents. So that's the only reason I say I like to be 90 to 95% below, or I'm sorry, 5 to 10% below what rents are, somewhere in that range. It's just a little more incentive. It's a little easier to find that buyer. It's a little easier to get to lock that buyer in and get them into a house that. And again, we're building. I'm building in affordability is what I'm trying to do. That's what I'm saying.
Yeah. Well, this goes back to what you said. And I know maybe we should make sure we highlight this point. You want your buyer to perform. You're the bank. Banks don't want to take property back.
Right.
They will if they have to, but they don't want to. They want performing notes. So why would you set, going back to what you said earlier, why would you set your terms up that are ridiculous and absurd that for failure? Like, well, I don't want the buyer to fail. I want to succeed.
Right.
Right. So that's going back to state. So that's why we use what is market rent as the primary question to drive. Okay, well, where should my payment be?
Yeah. Yeah, I mean, it's not an arbitrary number. I think that's what we're trying to point out is your payment is not some arbitrary number. We use rental comps as the benchmark, and we can adjust accordingly.
Yep.
So
and you want to just go into maybe it's time to let's just go over and highlight that with the example in the calculator.
Sure.
Let me share my screen here. Give me just a minute while I work through my technology items. If Skynet will permit me the courtesy of sharing my screen. There we go. You can see that
on Skynet.
Yeah, you can see that on there too. So this is, as Jeff mentioned, this is our free Sub-2 profitability calculator. You can go to our website and download it. Free. It's particularly geared towards Sub-2 deals, so that's what we're going to highlight. And this is not a podcast about using the calculator. This is just using the calculator to illustrate what we've been talking about here today with setting your payment. Okay. So in order to use the calculator, you need to put in your information that goes here on this first tab where it says, you might not be able to see that down here at the bottom, it says acquisition assumptions at the bottom, and everything in green you have to fill in. So you need to know this. So we're just going to say this is 123 Walnut Street. We're going to say the after repaired value. In other words, if it was in great updated condition and we put it on the retail market, what's the number? We're just going to arbitrarily say that's $270,000 for 123 Walnut Drive. Okay. What's the fair market value right now in the condition it's in? 225,000. All right. We have a loan balance.
Very simple calculation there. By the way, let's qualify these because a lot of people get fair market value and after repair value mixed up. Fair market value is your after repaired or your ARV minus repairs. That's all that it is. That's your fair market value. What will it sell for today?
Yes.
Sorry, I had to throw that in there.
Yes, and I actually skewed that a little bit for our example here too.
Yeah.
And I was going to bring up a point wise. So yeah, so if it needs $30,000 worth of repairs, then we would put 240 in here as the number. I put 10 in here, so I'm going to jump down here. I put $10,000 in for repairs, and let's say it does need 30, but I put 10 in here because that's the level that I know I can get it to get an end buyer to take it off my hands.
Right.
Okay. I don't need to get it up to fair
Totally
retail value.
Yeah.
I need it to get it up to maybe a little bit better than rent ready, you know, as people say too. But I'm just, and again, we're just arbitrarily picking these numbers too. But for the sake of the example here, that's what's going in here. I just arbitrarily put $5,000 in there for cash to seller. Maybe you got this off a wholesaler, whatever, closing costs, blah blah blah. Okay. And so the underlying loan here, the subject to, is we have a balance of $195,650. Okay, it's a 4.5% interest rate. It started in 2017, and I got all that information from the mortgage statement that I asked the seller for, and they provided to me. Okay, so that's where that information would come from. It was a 30-year loan. Here are the taxes, insurance, HOA. Again, I just arbitrarily made $2 a month on taxes, $200 a month on insurance, $50 a month on HOA, basically is what that would break down to. And then this calculates for you. You see right here on line 25, this line right here, that on those terms and conditions in there too, the monthly payment, this is just principal and interest, is $1,038.70. And that indeed, within a few pennies, is what matches on my mortgage statement that they provided to me. Okay, so that's how you verify that. All right, now we're specifically talking about setting your seller financing this. So I'm going to go to the owner finance exit tab. That's my seller financing information. And it magically took all this gray stuff. It took from the first tab and pulled all over here for me. Okay. So now here's where the magic happens, Mr. Kaufman, right here in this area where it says exit. And so I already had some plugged in too. But let's talk a little bit about what is my price. So I know, so I put in there too, it's worth like $225 right now. Okay, going back to it's $225 in the condition it's in. I'm going to spend $10,000 getting it ready. I'm going to want to bump in that. I'm going to raise my price above that fair market value, and you can pick what you want. We usually just use 10% as a rule of thumb and see where that pans out. But you could have it be 8%. You could have it be 5%. Right? Okay. So in this example though, we're just going to leave it at 10%. So in other words, I'm going to sell this. I'm going to create my purchase price and I'm going to sell this at $247.5. After I spend $10,000 fixing it up and $5,000 to acquire it. Okay. That's just,
which by the way is a steal, because if you look at the ARV on this is yet another incentive for a buyer. They're getting go back up, go scroll to the very top there real quick. Look at what the that was 225. Okay. Oh, I'm sorry. We don't have the ARV.
Fair market value. We're going off the fair market value here, but you're right. Yep. In totally updated condition, switching back, 270 is what the comps told me.
Right.
Okay.
So this is a value for the buyer.
Good value. Very, very much so. But I don't want to spend 30 or 40,000. I don't want to spend 40,000 getting it. I don't need, the kitchen's functional. I can put an end buyer in there and have them update it to what they want.
Right.
So I'm going to take that into consideration when I set this price. Right. So that's why we're using that fair market number and going off it, the 225 number as opposed to the 270 in totally updated condition. Okay. So I'm looking to target that out. And of course, maybe you round it up to 250 or whatever it is, but I'm going to target selling that. My end purchase price is going to be $247.5. Okay. And remember, this is a subject to deal. So I got this deal for 195,650 plus 5,000, spending 10,000 on it in needed repairs. Maybe I'm replacing the HVAC and a couple other things, whatever. Okay. So I've got plenty of room there. Plenty of room. Okay. And so here is where you need to play with the numbers and meet your buying criteria, right? So my general rule of thumb on a seller finance thing is like I don't take less than 10%. Like we want to compete with the banks who usually require 10%, right? Unless it's a first time home buyer or a special program or something like that, 10%. Okay. Now you can play with that, but if I get 10%, which is 24,750, I now have become completely whole because I spent $15,000 on the property, right? 5 to acquire in acquisition cost and 10 rehabbing it. And now I've just received 24,750 and I'm whole in 10,000 to the good, right? So that, and again, you can decide that, but what are the chances, because you want this to be a long-term relationship. So what are the chances if you make this 3% that they are going to perform like someone that just paid you 10%?
That's right.
Right.
Yep. It's got to hurt a little bit. It's got to be a little. Got to be a little
Yep.
scary, from my point of view.
Yep. And then here you stick in terms. So we always just usually we just amortize it over 30 years, even if we balloon it, right? So the payments are going to be amortized 30 years. And that matches what the sub 2 was. It was amortized over 30 years. This is amortized over 30 years. Now you can also play with this here. You can go out 40 years. You can go out 35 years. You can do 25 years. So all kinds of different things you can do here. Okay. But we generally just match that. And here is, I just have 8% sitting in here as the interest rate. Now I need to plug a number in here because I want to see what this cash flow is right here. So you see this calculates the monthly cash flow after the subject to payment is made, right? And so I'm at 595.76 the way this is, and that happens to be 8% on the interest rate. That's beautiful, right? That's a great return because I want at least $400 a door.
Maybe what did you say? What did you say your the rents were in this particular?
Yep. And so right here, the owner finance, principal, interest, taxes, and insurance, because you want to make sure they escrow, right? You want to collect all that in the escrow, is $2,184.46. We'll just round it to 2,200, and that is the top of my rent market, 2,200.
That's perfect. Perfect.
So that's what I would say. I would want to set that at 2,200. Now, you can say, well, no, I need to be 2 points above the going rate, which is 7% or whatever. So I need this to be 9. Okay, you can maybe get away with 9. You're at 23.42 there. Somebody could pay 23.50 for that, maybe on a seller finance deal. And now your cash flow is over 750 a month. That's great. And you say, oh shit, well, I'm not doing that unless I get 10%. Okay. Right? Pigs get fed, hogs get slaughtered. How to do it, Mr. Kaufman. I know that's your favorite term. Like, stop being greedy. Okay? Stop being greedy. Like, you can push it. Like, I don't mind pushing it. I push it a little, right? We can push it, but you want your buyer to perform, right? And so this is just a beautiful thing. I'm $600 a month to the good. Let's do the deal.
Yep. Yes, sir.
All day, every day, right?
Yes.
All day, every day.
I don't know if we should get into this or not, but if you're looking at, if you go down to the lines 54, 55.
Yeah, these down here. Yeah, I'll see if I can highlight. There we go.
So how do we want, should we get into this? Do we want to get technical here?
You use a rule here that you want to too. So you want that loan constant and the spread and all that too. So yeah, I think it's okay because you use those numbers to determine your payments.
I do. So, well, actually, this actually determines for me whether or not this is a safe deal to get into.
Yeah. Yeah.
And so, so in order for us to do that, we need to be able to calculate what the spread percentage actually is. You'd want to be a minimum, and this does not apply. There are properties that are in really high dollar areas that this just can't apply to. But here locally, where we're at, in a flyover state here in the Midwest, we have to have a minimum of a 1% spread.
1%. Yeah.
Absolute, absolute. That's the minimum. We'd love to have higher, um, but the reality of it is, it really doesn't matter what that spread is if you're in some of those higher dollar areas, because you would then jump up to line 50 and you would calculate. So I guess what I'm trying to say is, if you're in a market where homes are much more expensive than they are here in, say, Missouri, you if you meet your minimum monthly spread, your minimum monthly cash flow amount, you can kind of ignore this calculation down here. But a lot of folks, cap rates are usually calculated on larger, like multifamily deals. Like, we usually don't use a cap rate in single family housing. Like, it's not feasible. You really don't need it, unless you want to know this information. Unless you want to know what your actual spread is, which I do. I want to know what my spread looks like on every deal. So we actually go in, we calculate the cap rate, and then we calculate what's called the loan constant. The loan constant is the actual cost of the debt service on an annual basis. So it's just debt service, where cap rate includes all of your expenses, your NOI, and all of your yearly expenses. The loan constant is just. Oh, by the way, your loan, your debt service is not included in your cap rate, in the calculation for cap rate.
Right. Right.
So we have to know what our loan is actually costing us, and so that's what a loan constant does. And I'm not going to get into the calculations for it. You can go out and look it up anywhere. It's readily available information. But this is actually what creates the spread between between the cap rate and the cost of the money that you're using. And in this instance, this is not for your buyer. This is not their information. This is for you. And so that loan constant calculation, remember, we bought this subject to. And so we get to use the underlying loan debt information, or the debt terms. I know I'm getting way too deep in this, but it is, if you just go out and you Google, how to calculate a cap rate, you then Google how to calculate a loan constant, you'll see what I'm talking about. It's really important information. It's actually how, once I know I have a spread above 1%, I know I'm safe on this deal. Like, this deal, unless the buyer just completely defaults on it. If this buyer made these payments for next 30 years, I know I'm safe, because I've got at least a 1% spread in the deal. So anyway, way too much information, and probably not enough time to explain all that.
Well, yeah, these are kind of detailed things, but really what you said is just no. If this is no, it's because your spread's not big enough, and then you need to go in there and change and start tweaking some of these terms.
Yeah, and I want to say on this calculation too, one last thing, and then I'll shut up about it. It does not matter what your cap rate is, and it does not matter what your loan constant is. You want them to be you want them to be a little higher, but really, as long as you've got the spread built in, that cap rate could be 4.37, as long as your loan constant is at least 3.37, you've got a 1% spread.
Right.
It's going to be a pretty safe bet.
Right. So that's how. So it takes the magnitude of the deal out of it.
Right.
And it just boils it down to, okay, what is the spread?
It takes the guesswork out of it. Yeah.
Yeah. So that's a little quick. Again, this isn't about the calculator tutorial too, but this is how we use, and we actually use this calculator and do this to determine what the number is and what am I going to charge right here. What am I going to charge the end buyer, and is it reasonable, and will they succeed? That's what hopefully we were able to get across,
That's
right,
right.
in the demo. So, all right, I will stop sharing my screen and we'll wrap this bad boy up. Stop sharing. There we go.
Yeah, there's so much more we could talk about this, but
Oh, well, we could go into this. We
yeah,
could take a deep dive into just different components of the calculator
I'll tell
too.
you what. Let's save that for the next one,
There you go.
because there's a lot more. There's some more issues with this. We just wanted to show you how we come to that monthly payment, and I probably shouldn't even have gone to the loan constant cap rate stuff. It's a little too much information. I think that's going to be it, right? I mean, are we good with
Yeah,
that?
well, and we touched on it, but just to reiterate too, when you become the bank, you need to vet your borrowers. You don't necessarily need to go through the whole underwriting procedure that the bank does. We're not necessarily suggesting that unless you want marketable notes and you use
Well,
a
you bring up another really good topic, which here's what I do. We'll do some homework. We've done this before.
there you go.
Homework. Go out and look up qualified versus unqualified
Yep.
loans.
Yep.
Okay, so and you'll find that specifically look in the Dodd-Frank Act, or look in Dodd-Frank, and you'll see what I'm talking about. I do mostly unqualified loans. That's just what I do. It's
Yep.
simple. And the underlying is the underwriting is far less stringent than it is for qualified loans.
Yep.
So yeah,
Yeah.
I'd say
The biggest
a lot
yeah,
that goes into this.
yeah. So sorry, the biggest thing is like, can your buyer make the monthly payments?
That's right. In fact, in Dodd-Frank, I'll just summarize it for you. It is, I think it literally says something along the lines. I'll paraphrase because I don't know the literal uh, the literal definition, but paraphrasing, it literally says that in non-qualified loans, um, your buyer must be able to show the ability to repay. I think that's all that it says. I'd have to go back out and refresh my memory, but it's very, very vague, extremely vague. Um, so we do still have to comply with Dodd Frank, even though we do unqualified loans, but the qualifications are uh, really kind of up to interpretation, if I'm being honest.
Yeah,
So
whatever meets your remember you're the bank.
yeah,
So whatever meets your underwriting criteria, right? That's what we're
yeah,
going to go with.
yeah,
The and I just like to say too, is like that was a quick overview, right? There's a lot of details that go into all this too, but that's what you get when you partner with us. So I did the shameless plug there at the end. So we went all 45 minutes almost with that shameless plug at the end. Partner with us, and we go through all that step by step, right? So the first thing we have to do is to acquire the subject to property. So we start there, and then we go all the way on to the buyer side as well too. So
yep, yeah. People are doing this stuff every day, guys. So yeah, we'd love to chat with you if you are interested in kind of modeling what we do and implementing it in your own business. Give us a call. We actually there's a link out there on the website. Set up a meeting with us,
well, you bet.
and be happy to talk to you.
You bet. Yes, we're very nice gentlemen. Like there's no this like you actually get us right now too. I mean, so yeah, go set up that call and we'll talk to you directly.
Yep. All right, guys. I think we're going to call it.
Yep.
We appreciate you joining us, and we'll catch you guys next week.
Have a great week.
Take care.